Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Christian. It's fantastic to have you on the podcast show.
Hi, Bilal. I'm super excited to be here. Thanks for the invite.
Great. Now, before we go into the meat of our conversation, I do like to ask my guests something about their origin story. So it would be helpful if you tell us what you studied at university. Was it inevitable you'd end up in finance and also in more on the end up in sort of the quant AI data science side of things as well? What's your story?
Cool. Yeah, of course. So I'm a mathematician by training. I studied at the Technical University in Munich. I studied financial mathematics with a heavy focus on statistics, stochastic processes, that kind of thing. Wrote my diploma thesis about credit portfolio management using a special type of copula, so dependency structures. The industry partner that supervised my thesis was a person called Christian Blum, who until very recently was the chief risk officer of UBS Group, and who I'm very grateful for supervising the thesis and then taking me on at Credit Suisse in Zurich in the private banking unit, where I was part of his credit portfolio management team. And after a year, Credit Suisse gave me this amazing opportunity to go anywhere within the bank, in any department, any location. And my bosses found Richard Martin, who was Quant of the Year several times in Risk Magazine in the early 2000s, and created this opportunity for me to go to London into his quantitative credit strategy team. And I joined there, and after I was supposed to go back after half a year to Zurich, but Richard, made me an offer I couldn't refuse, and I stayed in London. And pre-GFC, global financial crisis, we were optimizing CDOs, collateralized debt obligations, as I guess many people after watching the Big Short movie now know what those are. And then after the GFC hit, we were, I think a story of my career, and I think you might ask me later, about advice for juniors, is I adapted throughout my career whenever opportunities arose, and tried to turn obstacles into opportunities. And the GFC was a huge, change and cuts in many people's careers, and so in my case, I basically used this opportunity and did a bit of portfolio management for the trading desk. I think that created a bit of credibility at the trading desk for me. And when the financial crisis turned into a sovereign crisis, I looked at it from a very different angle to most observers. I would say that most people were looking at it through a very Anglo-Saxon and very political angle, and I used game theory at the time to come to very concrete and tradable conclusions that allowed me to speak to the world's greatest hedge funds, and that in itself allowed me to learn a lot about macro markets and the economy, and I learned a lot during that time. And then in 2013, Mr. Draghi said, "Whatever it takes," and suddenly people were not interested anymore in sovereign crisis and game theory and what have you. And again, I adapted, right? And I at the time, the credit trading desk had started recording electronic inquiries, and they sort of tasked me with looking at those, given my statistical and mathematical knowledge and the sort of domain knowledge that I had built over time. And I actually really think that the combination of those two are absolutely crucial in financial markets if you have a quant role. And so, started to look at those inquiry data and build some trading signals that I believe were still in operation until the recent merger. And then I left CS in 2015 and thought a bit about, my next career move and what I wanted to do strategically. And I came across machine learning as a what I think is a very powerful tool in a well sorted toolbox. And I found these online training courses from Andrew Ng, and I was fascinated by him as a teacher. I think he's probably one of the smartest people on the planet because he can turn really complex concepts into very straightforward teachings, and I really admire him for that. And so I concluded that I wanted to do what sort of was emerging as data science and machine learning, but within finance. I felt that the domain knowledge that I had built and the mathematical foundations would make that a very attractive proposition. And one of the traders that I had built the trading signals for, he had moved to a Japanese bank called Mizuho, very big, one of the mega banks in Japan. And I joined there. I was tasked with building those trading signals out into an algorithmic trading strategy. And I spent 3 years there. And then a very important point in my career was when I met Alexei Kondratyev, who was Quant of the Year in 2019. And the two of us met at a risk conference, and we were speaking about the idea of producing synthetic market data. And we wrote a paper together called the Market Generator. We followed up with a second paper, and they were both published in Risk Magazine. And I was presenting at the Alan Turing Institute. And ever since then, I've had this idea in my mind of how to take that further, how to apply it to time series and their sort of uniqueness. And so I spent the last 5 years at Standard Chartered, and I'm currently leading the credit trading data science team. And
yeah, that's great.
That's the rest is history.
Yeah, it sounds like you've been very fortunate to work with some really good people over the course of your career, which has been really instrumental for your development, it sounds like. So you've been very lucky in that sense.
I'm very grateful, yeah.
Yeah, one thing, also just for the benefit of our listeners, anything you'll be saying on this podcast are your personal views and related to your academic and public works, rather than any, you don't represent any institution on this call in terms of the views you're talking about. Now, I wanted to start sort of big picture. And obviously, there's been a lot of hype around AI over the past year and a half. Actually, pretty much since OpenAI launched ChatGPT, and then we've seen the performance of lots of AI-related stocks, NVIDIA and so on, and do incredibly well. And it kind of begs the question of, where are we in the hype cycle? I mean, is AI real? This hype that we're seeing, these expectations are really elevated, or are we in this sort of bubble phase of AI? What do you think?
I think so. I am very impressed with the capabilities, and I think there is a very huge hype at the moment. That's not to say that there are not very impressive capabilities, but in my mind, there is a bit of frothiness, and I do think that there's a sort of 10 to 20% chance of another AI winter. And that might be a very sort of anti-consensus view, but the reason why I think that is severalfold. There's one, expectations are rocket high, right? And it's difficult to keep up with that, especially in terms of commercial impact, of which I would say to date, there hasn't been seen that much. And there's several reasons for that, right? Because AI is all over the financial industry. The fraud detection is something that's been probably implemented in 2016 or something around that time using traditional machine learning. The problem, though, is that it's not called AI anymore. And I think the goalpost of what's called AI is shifting all the time. The benchmark's going ever further up before something's being called AI. And there's a couple of other examples. Image recognition, where people were using satellite image data to identify tankers filled with oil, and based on the shadows, and they could tell how much oil there was in a tanker, and similar with oil reservoirs. That was definitely called AI at the time, and now it's just image recognition and very commoditized. Similarly with natural language processing, when you news sentiment translation, I think that was something that was very much looked at as AI at the time. And when you now look at the capabilities of LLMs and ChatGPT and others, it looks a bit sort of standard, right? And so my point is the goalposts of what's labeled AI are shifting up all the time. I think it's also difficult to attribute the commercial value of these things when they're in operation. It's difficult to isolate them and say, okay, this extra million or billion that you've had in revenue is due to AI, or this cost save. And I also think that in large and particularly regulated institutions, the adoption of AI is slower, and for a good reason, right? Those institutions need to protect their customers, and in the case of financial institutions, the integrity of the financial market. So I think there's a reasonable chance of 10-20% that there might be another AI winter.
Okay, it's good to hear some realism introduced into this conversation, because it's very easy, especially if you go into social media, to think that this massive revolution is about us. Now you're in credit markets, and when I look, I've been in financial markets for a long time, like yourself, and what I find is that say machine learning has been adopted quite well into markets like foreign exchange and equities, in particular, those two markets. If you look at market making desks, the algorithms used within the e-trading platforms, many of them have introduced machine learning techniques. And then equally also in terms of asset managers, hedge funds, with these very sort of liquid markets like FX, futures, equities, people have been able to use machine learning type algorithms to generate alpha, you could say. But credit, in terms of the spectrum of assets, credit seems to be one that's lagged the most. And so I just wanted to ask you, why is that?
It's a very good question. I would say primarily the role of electronification. Equity and FX markets have been electronified for a very long time. And my understanding is, as you say, I'm a credit market expert, not a macro expert, but that there's about, millions of trades in liquid macro assets per second. In credit, I would say that, in corporate credit, in liquid bonds, you maybe see a couple of 10s or 20 times of trades per day in a liquid bond, right? And as a result, there's just a lot less data, both due to this liquidity situation, as well as the fact that credit markets are in the process of being electronified, and the electronification is increasing every year. But you still have these situations where clients call their salespeople on the actual phone line, and the sales guy talks on the trading floor, or shouts over to the trader to get a price. So those situations are obviously rarer, but still exist. And especially when you're talking about relatively large sizes and therefore very sensitive transactions. They, as a machine learning or a data scientist or quant, that makes it challenging to build anything, because of course, if you want to calibrate a model, you need data, and also I would say you need not just lots of data, you also need a diverse set of data, a data set that represents the full width of the probability distribution. And the fact that we are now recording data is great, but we haven't got data from the early 2000s or 90s or even before, right? Which other asset classes do. And so that means that when you train a model on historical data that goes back to, say, 2010, which some providers provide, then you're missing a lot of information about the GFC or the dot-com bubble and burst, or even, the inflationary environment of the 1970s, which is probably a very relevant environment in nowadays markets. And that makes it hard for credit people that operate in this quant space. And because I've been thinking about this for such a long time, I decided, to come up with a solution. And there's a Gen AI solution that I've put pen to paper in a recent paper that I've published. And it basically allows us to produce synthetic credit market data. It is the same principle as ChatGPT and the others. You basically create a virtual reality. You train it on the history, and you basically aim to learn the probability distribution, not just of individual days or time slots. You try to learn the actual probability distribution and the governing process of the stochastic process of the time series. It's similar to Arima-Garch models. Those are linear. And so this paper advances on those and generalizes on those and is able to produce nonlinear relationships between variables, and therefore is a lot more complex and, I would argue, more realistic, because sometimes you have nonlinear events in markets, and it's important to be able to model those. And then having learned the probability distribution, we can then sample from it. So the equivalent in the other Gen AI spaces that people might be more familiar with are, when you prompt ChatGPT with your text and it produces another text or maybe an image, it would have learned the probability distribution of images with dogs, say, right, or cats. And so now it produces a synthetic image of a cat or a dog that doesn't exist in reality, but it looks like it. And the same principle applies here. We basically produce, with this model, we can produce synthetic time series of markets, credit markets, that look realistic but have never taken place in this way. And that means that you have suddenly unlimited, very realistic data that you can use for calibrating trading strategies, backtesting trading strategies, scenario analysis, risk management, and so forth.
I mean, one question I have that comes up is, some of the examples of like ChatGPT generates text and then also like images. Those types of outputs are within stable distributions. There's a certain sort of boundedness of text. The language behaves in a certain way. Cats are cats. Today's cat is the same as yesterday's cat. But financial markets are very unstable. There's changes of regimes. You have fat tails, all the stuff Nassim Taleb has talked about over the years in all of his books, Extremistan and, all of that stuff, these tails. So how do you kind of capture that? Or put another way, when you create the synthetic series, and you said earlier that maybe credit data goes back to 2010, would it be able to generate a simulation of GFC within the simulation or not?
Yeah, really good question. So for the quants of the listeners, we're talking about stationarity, the fact that the probability distribution of your data changes through time, and that's a really important concept. So maybe for the layman, imagine you have a sort of image recognition model, and you train it on data on images of cats and dogs. And those images were all taken with the same camera in the same location, with the same light, the same angle, and just different cats and dogs basically in the center in the same position. And you train the model and it works, and you have like nearly 100% accuracy, if you like. And then you apply the learned model on pictures that you randomly take of your cat or dog at home with your iPhone somewhere in the garden. And almost certainly the model will struggle, or at least perform significantly worse, because the probability distribution has changed, right? And so the data science concept here is generalization. To what extent are you able to perform equally as well on your test set as on your training set? And in financial markets terms, to what extent are you able to generalize into any and be able to predict and simulate data of any market environment, not just the ones you've trained on. And that's where this non-linearity that I mentioned comes in and is very important, because basically when market regimes change, those are, you could call those the non-linearities, right? So you could think of an Arima-Garch model where the coefficients that are in the linear model governance process, they sort of like stay constant for a time, and then something happens, and then they drastically change, and then over time that they sort of like find another equilibrium. That's one way of thinking about it.
And just to be clear, the Arima-Garch approach is a sort of a statistical way of looking at time series, where you look at sort of past data, how that affects today's data, and then you create sort of predictions about how the trends will unfold. And as you say, regime changes suddenly when all the coefficients jump to something else, so the relationship just changes. Which you're saying that the traditional Arima-Garch model is not very good at detecting that, whereas your AI approach would be able to capture it much better.
Yeah, correct? I think there's some really good papers that show that Arima-Garch models basically retrofit stuff really well. And then when you use them out of sample, they completely break down. And I hypothesize that is largely due to this regime change and these non-linearities. That said, when you isolate sort of certain market environments and train these models within those, they behave pretty well. And you can see that these sort of like coefficients, you know, if you can sort of like retrain the coefficients every, say, 30 days or 60 days or whatever you want to do. And you see that the coefficients stay relatively stable within market environments, and then something drastic happens. And so the combination of the model being able to capture non-linearities, as well as the fact that I programmed it in a way that it can take external variables into account, allows it to identify market regimes and to sample from the current market regime you're in by having learned when the last regime change took place, and it automatically learning that the data within the current market regime is the most important for the near term. And one way to do this explicitly is, in the paper I've shown, I used equity market returns from the Euro Stoxx 50 as an external variable, and actually also the V2X, the Euro Stoxx VIX, as a implied volatility external variable. And just including those two in this model makes a big difference, because you receive basically this additional information about market pricing of forward volatility, which you could argue is an element of market regimes, right? So you could say low vol, high vol are different market regimes and so forth.
And then how do you know whether your synthetic data is working? Like, how do you know it's done well, your model? Or like, what's the benchmark, or what's the criteria, evaluation test? Yeah.
And so it's, again, really good question. There's some good papers that highlight quite a few metrics, and it really depends on the use case. Synthetic data is very useful, for example, for preserving data privacy and sharing data with maybe external partners without giving away the original data. In those cases, you probably would want to look at metrics like, how close the probability distribution is to your real data set, and you can use specific metrics like, your mean, your standard deviation, your correlations, and so forth, and just compare them. You can plot the synthetic data versus the real data, and just visually observe how well they fit. But in that
it's a good point on the privacy side. I didn't think about that. So if you need to share your data with somebody, but you want to hide the original data, actually creating synthetic data, you kind of get the best of both worlds. You're kind of sharing the characteristics, but you're very clear that's not the original data source. So that's a good use case, I think.
Yeah, and in that use case, another metric that's probably very important is to what extent have you been able to preserve privacy and anonymity. So the two are not equal. So just anonymizing a data set and removing all the names and addresses and so forth sometimes is not sufficient to preserve privacy. And I'll give you an example. If you have, let's say you have a medical data set, and you have all the names and addresses, and you remove those, and then you have, let's say fairly rare diseases or diagnoses, then the combination of certain features that are rare allows you sometimes to find a single entry, a single row, without actually knowing the name of the person. And you can, let's say, the height and the weight are included, and then those are, complete outliers, then you can sort of guess who it is. And the same in financial markets, right? There's, you can sort of identify players from looking at the data if it's an outlier. But then I think another way of assessing the performance of the model, and another very good metric, I think, is from a machine learning perspective, what's your ultimate goal? So if your goal is to develop a profitable trading strategy, then what you could do is you produce you train the model on real data, and obviously you have a training and test set. So let's say you've training data from 2010 until maybe before COVID, to make it a little bit more interesting. You train the model on that. You produce synthetic data, and then you have as many and as long time series of that synthetic data. And then you build, let's say, a reinforcement learning algorithm or something else that learns an optimal trading strategy, and you train it only with the synthetic data. And then you can test it, in terms of P&L and risk-adjusted returns and Sharpe ratios and Sartini ratios, but whatever you want, and say, okay, well, how well does the trading strategy perform both on synthetic test data, as well as real training and test data? And I think those are very interesting and exciting opportunities to really develop very sophisticated trading strategies without overfitting, and also overcoming this scarcity of data problem.
Okay, no, the great examples there. Now, just to get a bit into the weeds, in your paper, the sort of machine learning technique or AI technique you use to sort of help generate this is LSTM models or techniques. So can you explain what that is, and why didn't you use, say, transformer technology, which obviously is the big sort of fashionable technology today, which underpins LLMs?
Yeah, so LSTM stands for long short-term memory neural networks, and they're relatively old. And the reason why I use those instead of LLMs and transformer-based architectures is because I wanted to give something to the community of quant practitioners in finance. And since many of us work in regulated institutions, building a model is one thing, but putting it into production is a very different thing, right? Putting it into production requires IT and model validation, and maybe if it's an AI model, you might need responsible AI considerations, and these sort of teams or control functions are called differently in different institutions, but getting something in production means you need to have a lot of approvals, and I want to make it easier for these partners in the control functions by having something that's explainable. And the beauty about this LSTM model is that you can literally break it down into matrix multiplication, and there's a sort of hyperparameter in a model that you can use to make those matrices very sparse. So you basically end up with actually very few multiplications and summations, and a few nonlinear functions. So you can literally just write down the function, what the model does in functional form. And I think that is a huge advantage versus an LLM or a transformer-based model where you can't do that, right? The number of parameters in ChatGPT is, I think, in the hundreds of billions, if not trillions, with the larger models, and clearly that is a black box to any human being. The other reason why I used LSTMs is because in an edge case they replicate the Arima-Gauge models, and you can basically set the model in, and let's say, again, to make the engagement with our partners in the control functions easier. If you start with a model that is well accepted and well tested and established, then you can build on top of that, right? So you don't give a new model that no one's ever seen before, but instead you say, okay, well, in the edge case, it's this very well-known model, and now we'll just add a couple of bells and whistles that we are able to explain functionally, and I think that makes a big difference.
Okay, that's a great point. So yeah, it's a point well taken about the explainability, and also I guess the fact that LSTM's been around for a while just makes it part of the ether. People are familiar with it, so there's not so much resistance against taking on something new. I did have a question. You kind of mentioned about getting people to accept the models and so on. And one of the challenges I found, at least, when I tried to introduce some kind of innovative new process into a large organization, banks and so on, there's resistance from people, traders, salespeople, or whatever, because they feel threatened or they don't understand. All sorts of different reasons come into it. So obviously, you've been in a number of different institutions over your career. I mean, how do you get buy-in from people to effectively use these new techniques that take parts of their roles away, possibly?
Great question, and I think it's probably the most important question for practitioners in finance. I am convinced that the right way of doing this is by partnering with those traders. Now, I'll give you a very concrete example. I think that instead of coming into an institution and saying, I'm going to build this, AI-driven machine algo that's going to, do everything a lot more efficiently and, make more money and take less risks and what have you, I think that's completely the wrong way. And I think the way to do this is to partner with the traders, and you have to, because they have the domain knowledge. They know how the market works on a day-to-day basis. And so I think the right approach is to approach them and help them with their existing problems. And the solution doesn't have to be AI or machine learning. They might just have a spreadsheet that they've been using for years that sort of, gathers information, produces, insights, and they use those insights to trade. But maybe they have multiple versions of this spreadsheet across the desk, and maybe someone, copy pasted a value where there was supposed to be a formula and those type of things. So by translating that into code and scheduling it, and then, the next morning they automatically have all this information that they want at their fingertips. I think, in my experience, traders love that. And then you have a open communication channel, and then they come up with the next thing. They say, oh, I would love to know, how likely it is that I'll be able to trade a certain amount of notional in a certain bond. in a certain time, right? That would really help me to make my markets, and how far away from the mid should I put my bid and offers, and then you come back and build some sort of liquidity model. And again, the motivation doesn't have to be we're going to use sophisticated AI. My recommendation always is start with something very simple, something that's very intuitive and easy to explain, like a linear regression, and solve the problems quickly. And then 80%. And then what you'll find is that the traders come back and say, oh, this is great. There's this idea how we can improve this, right? And then you improve it together, and you end up with a situation where you have built all these sort of modules that help them with the day-to-day job. And then you can say, well, why don't we put these all together that you understand and that you want and that help you, and come up with a automated price that you can then use as a starting point when you respond to clients. And I think that's a very constructive and collaborative way of doing things. And everyone benefits, right? The quant guys benefit from the domain knowledge from the traders. The traders free up their time and can concentrate on what's important to them, understanding markets, forming views, talking to clients. And clients benefit too, because they get better and faster prices.
And that sounds great. And then in terms of the work that you've done on synthetic data, you talked about the use cases dealing with privacy issues, the application for trading models, and you've been working on this synthetic data project for a number of years now. You published a number of papers. What's the next step? Because at the moment, it's quite a sophisticated approach. LSTM, you've got some global or macro factors or equity factors within there. What's the next extension of this work?
Well, there's the extension of the work for me personally, and then I think for the community, the AI community in general. So for me, one route of extending this is to build this sort of reinforcement learning trading strategy that I mentioned before, and to really show in very commercially relevant metrics that the model works. Another one that I think is very interesting is causal AI. So I actually believe that it's going to be one of the very promising directions of new AI development, because if you think about machine learning and AI at the moment, it is basically identifying patterns, right? Correlations between variables. And I think correlations can break down, as we know. And if we assume that the probability distribution stays the same over time, then that's fine, right? That implies that the correlation stays the same. But if it doesn't, then I think a more powerful concept is to detect causality between variables. And I believe that that's an active area of research, and I'm very excited about that. Another area of AI research that's going on at the moment that I think holds great promise is agentic AI, where you have multiple AI agents that engage with each other, that collaborate. So you can think of a project where you have a team of software developers that are all AI agents, and you have one sort of product manager, one developer, one QA, and one sort of orchestrator. And they talk to each other all the time, and thereby you get a much better result than if you were to just prompt the LLM outright. And then you can connect these agents with tools, for example, with databases, or your supermarket login, and it's sort of like, or your email, of course, and your calendar, and it can sort of automatically engage with the environment that you give it.
Yeah, that sounds great. Now, I wanted to round off with a bunch of personal questions. Actually, the first one is on the generative AI side, ChatGPT and so on, outside of finance use cases, what have you found personally for fun most useful about the whole generative AI world that we've been in for the past couple of years? Or any sort of apps or tools that you found, oh, that's really cool?
Yeah, so I am very intrigued by some of these capabilities, and with the little time that I have, sometimes I play around with them. It's very fun, and I give away a bit of my age. So the first time I came to the UK was when I was 15, and I was sort of like in a student exchange from my high school, and it was 1995, and Oasis were, absolutely massive. I believe at the time they were giving concerts to 250,000 people. And now here we are 30 years later, and they're reunited, and obviously there's a lot of hype around that, and interesting news coverage. And so what I've done is I've asked ChatGPT to write a hypothetical new Oasis song, and that was fun. And there are tools at Runway ML, for example, where you can create videos. Suno is another one where you can produce music. I was very impressed with that the other day. So yeah, I think those are areas outside finance that are very exciting.
Great, it's good to hear. Another question: what's the best advice you've ever received on investing from anyone?
It's relatively basic, and I think most people in finance know this. But number one, diversification. I think don't put all your eggs in one basket. I think that actually applies to all life, not just finance. Another one is actually quite interesting. I find there's a big difference between trading signals and trading strategies. A trading signal might tell you, okay, bullish or bearish, and then when you translate that into a trading strategy that literally follows the signals, very, very often, most of the time, in my experience, they then actually don't make money once you take into account transaction costs. And that, I think, is a very big lesson to me. And I think a good trading strategy basically takes into account the expected transaction costs and the signals, of course, and various other things like risk, for example, and stop losses and so forth. And I think that those type of things are really important.
No, that's quite important, yeah.
And as a result, actually, in my personal investing, I try to minimize transaction costs and use ETFs, for example. So I mean, very basically, diversify very broadly and buy and hold, in my case, very often ETFs, and just sort of monetize the risk premium over time.
Yeah, that makes sense. And we touched on this one a bit earlier, but maybe there's something broader you want to say. What advice would you give to younger people? Specifically, some of our audience are people at university who are about to enter the job market. They often ask me what advice I want to give, so I like to push it onto my guests to help me with the answer. So what advice would you give to some young, smart person who's about to graduate?
I would say when they're still at uni, I would recommend to focus on statistics and probability theory and those sort of very basic mathematics before they jump into AI and machine learning. I find that those foundational things really help you understand why these algorithms work. And I think that's a great point, important.
Actually, Christine, because I find that the most successful hires we've made are people with math, statistics, econometrics undergrads and computer science postgrads, like masters, so they have this statistical foundation and then they build a computer science on top of that. So it's interesting that you say that too.
Yeah, I think, AI is a very broad field that attracts people from all sorts of areas, computer science, mathematics, physics, even neuroscience, right? And I think it's useful to have a mathematical foundation because that allows you, as I said, on the one hand, to really understand the algorithms and why they work, but also it gives you a language to speak with each other that is very unique. There's no interpretation with mathematics. There's a ground truth.
And actually, a lot of AI, I find, is a lot of it's linear algebra as well. So if you're on your linear algebra, the matrix maths, it helps.
Absolutely. I think the other things that I would recommend is, don't plan out your career. Stuff will happen. As I said earlier, you need to be able to adapt, and you need to, my strongest recommendation is like, be useful to the business. Try and have commercial impact. Don't be, obsessed about applying AI or whatever it might be that you're really passionate about. You can get there, but to build a career, you need to have commercial impact, and you need to build relationships and so forth.
No, that's great advice there. I also love books. So what are some of the books that influenced you, or perhaps books recently you've come across that you'd recommend to our audience?
Yeah, I've listened to some of your previous podcasts. I knew that question was coming, so I came prepared. So I am obsessed with this book. It's called Outlive from Peter Attia, and it's about health span. Some people sort of refer to it as longevity. I sort of almost live by the book. I have given it to all my best friends for their birthdays. It's sort of like the holy Bible to me. Another book that I recommend, or sort of it's a group of books. Another passion I have is sports and football, particularly, or soccer, as for American listeners. And there's some really good books, how data science and machine learning is being applied to football. So here's one of those books. It's called Net Gains. Another one that is actually earlier and really, really good is called Expected Goals. Really recommend that one. There's another one called Soccermatics, I think. This is the latest one I bought. I haven't actually started reading it, but has a very promising title. And Ian Graham, he was, I believe, the chief data scientist at Liverpool FC when they won the Premier League. So, he's got some,
by the way, so that's I'll definitely read that one.
and then I guess the last one, I think this is an old book, but I think it's absolutely foundational and everyone should read it. It's about causality, and as I said, I believe that maybe one of the next steps AI is going to take is in the sort of the causal space.
Well, there's a really, really great selection of books. I really appreciate that. And then finally, what's the best way for people to follow your work or to reach out to you?
Yeah, so please reach out on LinkedIn under Christian Schwarz. You can find me there, as well as on Twitter. I've got a handle there. It's called Explained by Maths.
Great. Okay, I'll make sure to include that on the show notes. So with that all, thank you so much for a fantastic conversation. Good luck with all the work you're doing, and keep up the publishing as well.
Yeah, thank you, Bilal. Thanks for having me. It was lots of fun.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.